Japan's GDP data released this week surprised the markets. Joining me to discuss is Stuart Allsop from BMI Research. So Stuart, GDP growth for the first quarter of 2015 annualised to 3.90. Are you expecting confidence to move the markets?
Well, I think that the market, in terms of the equity market, has largely priced in this recovery in GDP. We've seen almost a doubling of most valuation metrics over the past 2 years since the Bank of Japan really expanded its balance sheet. So we don't really expect to see a major acceleration in the equity market as a result of the recent growth figure. And in fact, it's our view that the growth pickup in Q1 is very unlikely to be sustained through the rest of the year. So we're forecasting growth of 1.2% for the full year, which implies a sequential slowdown, quite a considerable sequential slowdown over the coming quarters. So in terms of this direct impact on the equity market, it's probably likely to be quite muted. And I would say it's a similar force really driving the currency market. The currency sold off tremendously. It's down almost, I think, 40% from its peak against the US dollar. And this is largely being driven by inflation expectations increasing from, of course, years and years of expectations of prolonged deflation. And nothing really changes this outlook as a result of the GDP report. But one thing that we found quite interesting in the GDP report today, or yesterday, was the really steep increase in the GDP deflator, which was an indication towards that inflationary pressures are gaining traction, and this is very much likely to have a negative impact on the bond market, sending bond yields higher ultimately.
Consumer confidence decreased to 41.40 today. The US dollar and the Japanese yen reached around 124.40. Are you expecting the trend of the weak yen to continue?
There's a number of very conflicting forces acting on the yen at present. On the one hand, you have a strong current account surplus, which has benefited not only from a collapse in the value of the yen, but also much cheaper oil imports. So the terms of trade have really benefited. So there's a great deal of inflows coming in through the current account, but this has been considerably overwhelmed by the outflows in the financial account, and it's very, very difficult to see when this trend will reverse. So at some point, we will see the yen become an attractive buy from a fundamental perspective, when investors believe that, the weakness is already priced in the anticipated increase in inflation. But when you see currency moves like this that are very, very forceful, they don't tend to reverse in the near term. We're likely to see the yen stay weak for several months. In fact, probably most likely, the rest of the year. So we think while it's possible that if we start to see global recessionary pressures once again, if we start to see the US economy slow down, perhaps the yen could get some appreciatory pressure and head back to around 100. But the days of a strong yen are very much behind us, as Japan's economic system is really moving away from deflation and into inflation.
And even with positive data from GDP to banks lending higher than forecasted, economists are still expecting a slowdown. Are you expecting any changes to the bond markets and even to interest rates?
The government has around a net debt to GDP ratio of around 150%. They have a gross debt of around 250%. The problem with that is if they increase interest rates, the interest that they pay on their debt increases, and this poses a problem in terms of the outlays, in terms of government expenditure. So they will likely resist any pressure to increase interest rates. But what we think is a very plausible scenario is if the bond market itself starts to move the market for them. So we could see a situation where inflation expectations and inflation data come out very strong over the coming quarters, and that sends a signal to investors to sell their government bonds, This sends yields higher, and then the Bank of Japan has to step in, buy more bonds in order to keep interest rates very, very low. So our outlook for interest rates is one where they remain very, very low as they have for the past decade or more, but the downside risks are growing on a monthly basis. So you could see a very sharp increase in volatility. We saw this in 2003. We saw it actually last year, and we've actually seen a little bit of volatility in interest rate markets over the past month. And this is very much a sign of things to come in our view.
Well, that's all that we have time for today, but keep watching Dukascopy for the latest updates.